In the first 9 weeks of fiscal 2026, the United States government spent $104 billion just on interest payments. That is $11 billion every single week. Not on roads, not on schools, not on defense, just interest. If you're holding dollars right now, you need to understand what this number means for your future. This is not a budget problem. This is not a political problem. This is a death spiral. And it is the exact same trap that destroyed the dollar once before. On August 15th, 1971, President Richard Nixon walked into the Oval Office and did something that changed money forever. He closed the gold window. He told the world that America would no longer exchange dollars for gold. The reason was simple. America was drowning in debt. The Vietnam War cost billions. The Great Society programs cost billions more. Foreign countries were lining up to trade dollars for gold because they knew the truth. America had printed way more dollars than it had gold to back them. Nixon had two choices: hand over the gold and admit America was broke, or break the promise and cut the cord. He chose option 2. The dollar became a piece of paper, backed by nothing but trust. And for a while, that trust held. But here's what they do not teach you in school. That moment in 1971 was not a solution. It was a delay. Cutting the gold standard did not fix the debt problem. It just removed the alarm system. Gold was the constraint that forced discipline. Without it, the government could borrow forever. And they did. Fast forward to today. The national debt is $38 trillion. Not million, trillion. In 2020, the government paid $345 billion in interest on that debt. 6 years later, in 2026, that number has tripled to over $1 trillion. Let that sink in. The cost of servicing the debt tripled in 6 years. And it is accelerating. By the end of fiscal 2026, interest payments will be larger than Medicare spending, larger than defense spending in some projections. The Congressional Budget Office says the deficit will hit 6.7% of GDP this year. They are borrowing $7 billion per day just to keep the lights on. That is not sustainability, that is panic. Now let me address the elephant in the room. You might be thinking this is just big government waste, cut some programs, and we will be fine. But here's the problem. Even if you eliminated every single discretionary program tomorrow, the math does not work. Entitlements like Social Security and Medicare are locked in. Interest payments are locked in. Those two categories alone consume more than the government collects in revenue, which means every other dollar spent is borrowed. And every borrowed dollar adds to the debt. And every addition to the debt increases next year's interest payment. This is the spiral. The more you borrow, the more interest you owe. The more interest you owe, the more you have to borrow. And once you are in it, there are only 3 ways out. Option 1 is you cut spending so deep that you balance the budget and start paying down debt. Politically impossible. Nobody is cutting Social Security or Medicare. Option 2 is you grow the economy so fast that tax revenue catches up. Mathematically impossible. You would need double-digit GDP growth for a decade straight. We have not seen that since World War II. Option 3 is you print money and inflate the debt away. This is what always happens. This is what happened after 1971. The moment Nixon closed the gold window, the dollar started losing value. Inflation in the 1970s was brutal. The dollar lost 40% of its purchasing power in 1 decade. Gas lines, stagflation. Interest rates hit 20% by 1980. Your grandparents remember. And we are walking into the same trap right now. Here's why 2026 is different from 2020 or 2015 or 2008. Back then, interest rates were near zero. The Federal Reserve could borrow trillions and the interest cost was manageable, but rates are not zero anymore. The Fed hiked rates to fight inflation, and now every new dollar borrowed costs way more to service. The Treasury issued $158 billion more in debt in the first half of fiscal 2026 compared to the same period last year. That is not slowing down. That is accelerating into the curve. And here's the kicker. The bond market is starting to notice. When the bond market loses confidence in your ability to pay, the consequences are catastrophic. Bond yields spike. Borrowing costs explode. And the government has to print even more money just to cover the old debt. This is called fiscal dominance. It means the central bank loses control. The Federal Reserve can no longer set interest rates based on economic conditions. They have to set rates based on what the Treasury can afford to pay. If rates go too high, the government goes bankrupt. So the Fed has to print money to buy the debt. And when the Fed prints money to buy debt, that is called monetizing the deficit. It is the final stage before currency collapse. Economists have been warning about fiscal dominance for years. In early 2026, analysts confirmed the Fed is already trapped. They cannot raise rates without breaking the Treasury. They cannot lower rates without reigniting inflation. They are stuck. And this is exactly what happened in 1971. Nixon did not close the gold window because he wanted to. He closed it because foreign governments were draining Fort Knox. France alone demanded $191 million worth of gold in 1971. Germany and Switzerland were lining up behind them. The U.S. gold reserves dropped from 20,000 tons in 1957 to 8,000 tons by 1971. At that rate, the vault would have been empty within 2 years, so Nixon had no choice. He severed the link, and the world entered a new monetary era, an era where money is just paper, where governments can print unlimited amounts, where the only limit is confidence. Sound familiar? Because we are living through the sequel right now. In 1971, the constraint was gold. Today, the constraint is bond market confidence, and that confidence is cracking. Look at what happened in December 2025. The U.S. posted a record $145 billion deficit in a single month. That is the largest December deficit in history. Outlays jumped 13% compared to the year before. Receipts stayed flat. The gap is widening. And the Treasury has to sell bonds every single week to cover that gap. But here is the problem. Who is buying? For decades, foreign countries bought U.S. debt, China, Japan, Saudi Arabia. They trusted the dollar as the global reserve currency. But that trust is fading. China has been dumping treasuries for years. Their holdings dropped from over $1 trillion to around $800 billion. Japan is still a big holder, but they have their own debt crisis. Their debt to GDP ratio is over 250%. They cannot keep funding America forever. And oil exporters are diversifying into euros and yuan. The petrodollar system that recycled oil profits into U.S. treasuries is breaking down. So if foreigners are not buying, who is? The Federal Reserve, American banks, and pension funds. But even they are reaching their limit. In 2020 and 2021, the Fed bought trillions in bonds through quantitative easing. They expanded their balance sheet to $9 trillion. Then inflation hit, and they had to reverse course. They started quantitative tightening. They stopped buying bonds and started selling them. That means the Treasury lost its biggest buyer, and now they have to offer higher yields to attract new buyers. Higher yields mean higher interest costs, which means more borrowing, which means more bonds to sell. Do you see the loop? This is the trap. And it is accelerating faster than anyone predicted. The Congressional Budget Office projected interest costs would hit $1 trillion by 2030. They hit it in 2026, 4 years early. That is not a rounding error. That is a structural collapse happening in real time. Now let me show you what this means for your wallet. When the government borrows trillions and the Fed prints money to cover it, the currency loses value. Not tomorrow, not in a dramatic crash. Slowly, steadily, invisibly. Your paycheck stays the same. But groceries cost more. Rent goes up, gas goes up, healthcare goes up. You feel poor, but you cannot pinpoint why. That is inflation, and inflation is a hidden tax. It transfers wealth from savers to borrowers, from the middle class to the government, from you to them. In 1971, the average American had no idea what closing the gold window meant. They did not understand monetary policy or reserve currencies. They just knew that things got expensive. A gallon of gas cost 36 cents in 1970. By 1980, it was $1.20. A new house cost $23,000 in 1970. By 1980, it was $64,000. Wages went up too, but not nearly as fast. The purchasing power of the dollar got destroyed. And the people who got hurt the most were the ones who trusted the system, the ones who saved cash, the ones who kept money in the bank thinking it was safe. They watched their life savings lose half its value in 10 years. Meanwhile, the people who owned hard assets did fine. Real estate, gold, silver, commodities. Those assets kept pace with inflation or beat it. Gold went from $35 an ounce in 1971 to $850 by 1980. That is a 2,400% gain. If you owned gold, you survived. If you owned dollars, you got crushed. And here's the scary part. We are in the early innings of the same playbook right now. The debt is exploding. Interest costs are exploding. The Fed is trapped between inflation and insolvency. And most Americans have no idea. They think this is just normal government stuff. They think someone will fix it. But nobody's coming to fix it because the fix requires pain, massive spending cuts, tax hikes, a decade of austerity. No politician will vote for that. No voter will support it. So they will do what they always do. They will kick the can, they will borrow more, they will print more, and they will let inflation do the dirty work. Because inflation is quiet. It does not require a vote. It does not show up as a line item in the budget. It just slowly erodes your wealth while the government pays off its debt with cheaper dollars. This is not a conspiracy theory. This is monetary history. Every empire that borrowed beyond its means ended the same way. Rome debased its currency. Weimar Germany printed until the mark was worthless. Zimbabwe printed until people used trillion-dollar bills as wallpaper. The script never changes, only the names and dates. So what do? You cannot stop the debt spiral. You cannot vote it away. You cannot protest it into submission. But you can protect yourself. The playbook is simple. Get out of paper, get into hard assets. Gold and silver are the obvious moves. They have been money for 5,000 years. They cannot be printed. They cannot be inflated away. They hold value when currencies collapse. Silver is especially interesting right now. It is trading at historic lows compared to gold. The gold to silver ratio is over 90 to 1. Historically, it averages 60 to 1. That means silver is undervalued by 30% or more. And industrial demand for silver is exploding. Solar panels, electric vehicles, electronics. Every green energy transition requires massive amounts of silver. Supply is tight, demand is rising. And when governments start printing to cover their debt crisis, precious metals will explode. Real estate is another hedge if you can afford it. Property holds value during inflation. You can lock in a fixed rate mortgage and pay it off with cheaper dollars. Rent goes up with inflation, so your income keeps pace. The key is to own things that cannot be printed, things that have intrinsic value, things that people will need no matter what happens to the dollar. Now here is what you should not do. Do not sit in cash waiting for things to get better. Do not trust that the government will figure it out. Do not assume this time is different. It is not different. The math is the math. 38 trillion in debt, 1 trillion in annual interest, 7 billion borrowed per day. Those numbers do not reverse without a crisis, and when the crisis comes, it will be too late to move. By the time the mainstream media is screaming about currency collapse, the price of protection will be 10 times higher. The time to act is now. While silver is under $30 an ounce, while gold is under 3,000, while most people are still asleep, this is not fear-mongering. This is pattern recognition. We have seen this movie before. We know how it ends. The only question is whether you position yourself on the right side of the trade. Share this video with someone who needs to hear it. Subscribe if you want to stay ahead of what is coming, and drop a comment. What are you doing to protect your wealth right now?